I am going to give you a victory lap. You were right. I was wrong, especially last year when I thought things were looking pretty harrowing. And here we are, and it seems to be clear sailing, Larry. And what are the implications for markets and the Fed?
Well, you got to remember also that this morning's wage numbers didn't include the revisions that we just got to personal income. They haven't trickled their way down into this report. So the increase in wages is actually about 1.6% higher than what was reported. So it isn't 4.4, it's 6.0. You know, that's way, way off anything that would come close to a 2% inflation target.
Go ahead.
Sorry.
No, go ahead.
Yeah, well, and you not only have, what was interesting, I thought, about this is Harold Daggett, who's the head of the union, said, he said it on your show, I believe, we want 61.5%. And they got exactly 61.5%, which shows that he has enormous bargaining power and credibility. And as you noted, there are similar problems going on at Boeing and at the various auto companies. So unions have it in their heads that basically 8.5% pay hikes are quite gettable. Management here caved to that amount. At the other companies, they're talking about 6.5 to 7 is what the offer is. So you have to have wage increases under 4 if you want to get to 2% inflation. And we are just nowhere close.
So if we're nowhere, we're in the neighborhood of 2% in the very, very short term. We're probably below that if you go, super core on a 3-month running average or something to that extent. But I want to really ask this much bigger picture question. Is this the soft landing or the no landing? Does the Fed actually need to do any more rate cuts at this point? And what does this mean for the stock market?
Well, first of all, it almost certainly means further steepening of the yield curve. We saw a lot of that today. I think the Fed has to think very carefully about its next rate cut, because since the last one, we've seen the 10-year rise something like 25 bips. So if you're cutting rates on the short end and you see the response on the long end going the other way, then you're probably doing something wrong. So my suspicion is that they're probably going to have to pass at the next meeting.
Pass entirely.
Pass entirely. They probably,
What's going to happen if they keep cutting? What are the risks?
Well, they're validating those inflation expectations that the unions and management seem to have in their heads about inflation going forward. Remember, this is what we're talking about are the next 5 and 6 years, depending on the particular negotiation. So these folks aren't worried about this month's or this quarter's inflation print. What they're saying is that inflation will be enough going forward for the next 5 to 6 years to validate this level of wage hike. It's fine for the unions to demand it. For the companies to give something like that means they've got to expect that they're going to be able to collect it on the top end in order to lose it in terms of wages.